Hey there. Today we're diving deep into one of the most important aspects of trading, mastering your mind and emotions. There's one universal truth in trading, be it stocks, cryptocurrencies, or Forex. Your psychology controls your profits. In fact, you can have the most profitable strategy in the world, but without control over your emotions, it's likely you'll blow up your account. In this video, we'll break down how to master your emotions, stick to your trading plan, and avoid common psychological traps that lead to bad decisions. From controlling greed and overtrading to staying disciplined when the market volume is low, I'll give you everything you need to approach the market with a clear mind and a proven plan. Oh, and by the way, I'll also share some of my favorite mechanical trading strategies and explain how to practice trading on platforms like TradingView, so stay tuned until the end for those golden nuggets. Ready? Let's get started. Let's start with a bold but truthful statement. Trading is a psychological game more than anything else. Sure, we need strategies, but ask any seasoned trader and they'll tell you that the hardest part of trading is controlling your emotions. Think about it. You're staring at the screen, watching the price action move up and down, and with every tick, your heart races. Fear creeps in when you see losses, and greed kicks in when your trade is in the green. This is where many traders fail. They react emotionally rather than logically. It's common to hear traders say things like, I know my strategy works, but I keep messing it up by overtrading or hesitating. That's the crux of trading psychology. Even with a solid strategy, emotional mistakes like hesitation, revenge trading, or impulsively closing a trade too soon can sabotage your success. So, how do we combat this? We'll start by breaking down why emotions matter and how they influence your decision making. Fear and greed are the two dominant emotions in trading, and they both can lead to poor decisions if not managed properly. Fear often manifests when you see a trade moving against you. It causes traders to close positions too early, avoiding further losses, but also missing out on potential recovery. Greed, on the other hand, kicks in when you're in profit and want to squeeze out just a little bit more. This can result in overstaying in a trade and watching your profits disappear when the market reverses. Both of these emotions are natural, but controlling your mind in trading is about minimizing emotional responses and sticking to your plan. Let's break it down with an example. Imagine you're in a trade and the market moves in your favor. You're up 15% and you start thinking, what if I wait for 20%? This trade could make my month. That's greed. Instead of sticking to your plan and taking profit, you risk holding longer. Then the market shifts and you're back to break even, or worse, in a loss. This is where having a plan for entry and exit is key. Knowing when to take profit or cut your losses should be part of your strategy, not something you decide in the heat of the moment. We'll cover how to plan these points in detail later, but for now, understand that emotional control is essential to long-term success in trading. Emotional control in trading comes down to two primary factors: preparation and discipline. Before you even enter a trade, you should have a clear plan that includes your entry point based on your analysis, a predetermined stop loss in case the trade moves against you, or a target exit for profit taking. Having these set in stone before the market even opens helps you avoid emotional decisions once your trade is live. There's no room for second guessing because the rules are already in place. Discipline. Once your plan is in place, the next step is sticking to it, no matter how tempted you are to deviate. This means not moving your stop loss to avoid taking a hit. not holding on to a winning trade too long because you're hoping for a bigger payday. A lack of discipline is what leads to overtrading, one of the biggest emotional pitfalls traders face. When you're emotionally charged, you're more likely to jump into unnecessary trades. Overtrading often comes from the fear of missing out, FOMO, or from trying to recover a loss. Here's a trick that works for many traders. After each trade, take a break. Step away from the screen for a few minutes to cool off. This is especially important after a loss, as emotions are likely running high. Taking time to reset helps you come back with a clear mind. Remember, you're not just battling the market, you're battling yourself. Sticking to a trading plan is arguably one of the hardest things for traders, especially when emotions are involved. You've probably heard the saying, plan the trade and trade the plan. Sounds simple, right? But when you're in the heat of the moment, it's surprisingly easy to veer off track. Here's a detailed look at how to create, and more importantly, stick to your plan. Define your strategy. Your trading strategy should be something you understand well and are confident in. It doesn't need to be complicated. In fact, simpler strategies often work best because they're easier to stick to. Mechanical trading strategies. These are systematic approaches that take emotion out of the equation. For example, a strategy that relies on technical indicators like the moving average convergence divergence, MACD, or the relative strength index, RSI, can give you clear signals for entry and exit, helping you avoid the emotional roller coaster of making subjective decisions. Point of control strategy. This strategy uses volume profile analysis to identify the price level where the most volume has traded. Knowing the point of control helps you find key support and resistance levels, which can act as psychological anchors for your trades. This is especially helpful when market volume is high, giving you clear data points for your plan. 2. Set your risk management parameters. Good risk management is the backbone of every successful trader's plan. Without it, you're essentially gambling. Risk management includes setting stop losses and position sizes. Never risk more than you're willing to lose on a single trade. A good rule of thumb is to only risk 1–2% of your trading account on any given trade. That way, even if the trade goes south, it won't destroy your entire account. By controlling your risk, you'll find it easier to control your emotions. The fear of losing your entire account is significantly reduced when you have a solid risk management strategy in place. Establish time limits for your trades. Don't stay in trades longer than you planned. Once you've reached your target profit or stop loss, exit the trade. If you're day trading, holding a position too long can lead to unnecessary emotional stress. Stick to your time frame. Finally, practice makes perfect. Use demo accounts on platforms like TradingView to practice your plan without risking real money. Keep a journal of your trades and review them regularly to see where you succeeded and where your emotions got the better of you. This is how you build a disciplined mindset in trading. The more you follow your plan, the more natural it becomes, and the less likely you'll fall into emotional traps. Volume is often an overlooked aspect of trading psychology, but it plays a huge role. High volume days tend to have more liquidity and clearer price movements, making it easier to stick to your plan. In contrast, low volume days can result in choppy markets, leading to frustration and overtrading. Here's how to approach both situations. On days with high volume, such as when major news is released or during earnings reports, the market moves more predictably. It's easier to find entry and exit points, and you're less likely to second-guess your decisions. This is when traders typically find it easier to control their emotions, as the market's direction is clearer. On low volume days, the market can behave unpredictably. Price moves can be erratic and cause emotional stress. It's easy to fall into the trap of hesitation or overtrading in these environments, trying to force trades that aren't there if the market is moving sideways. If the market is moving sideways, it's often best to avoid trading altogether. This is where traders must learn patience. Many traders feel they need to be in a trade at all times, but that's a mistake. Not trading is also a strategy. On low volume days, or when the market is moving sideways, staying out of the market is a great way to preserve both your capital and emotional balance. One way to avoid emotional decisions during low volume or sideways markets is to use mechanical trading strategies. These are systems that rely on clear rules based on price action or indicators. For example, some traders use the SMA, simple moving average, with specific settings to automatically trigger trades when certain price points are hit. This reduces emotional decision making and provides structure in uncertain market conditions. Overtrading is one of the biggest emotional pitfalls traders face, especially after a loss or during a low volume day. It's easy to get caught in the mindset of just one more trade in the hopes of recovering losses, or worse, trying to chase gains. But this is a recipe for disaster. Why do traders overtrade? Overtrading usually stems from one of two emotions, fear or greed. After a loss, fear can drive you to jump back into a trade to win back what you lost. On the other hand, after a win, greed can take over, convincing you that you're on a hot streak and should keep trading to maximize profits. But here's the truth. Overtrading kills your profitability. Every time you enter the market, you're exposed to risk. So, the more trades you take, the more likely you are to encounter losses, even if your strategy has a high win rate. It's about quality over quantity. How to avoid overtrading. 1. Set daily trade limits. Limit the number of trades you take in a day. This forces you to be selective about the setups you choose and helps you avoid impulsive trades. 2. Take breaks. After a losing trade, step away from your screen. Taking a short break can clear your mind and stop you from jumping back into a trade emotionally. 3. Stick to your strategy. Your strategy should include clear signals for when to enter and exit a trade. If you don't see those signals, don't force a trade. Waiting for a proper setup is often better than forcing trades in a sideways or low volume market. 4. Control greed. Greed is a dangerous emotion in trading. It can push you to stay in a winning trade for too long, leading to profit loss. The best way to control greed is to stick to your predefined profit targets and exit the trade when those targets are hit. Don't get caught up in, what if it goes higher? Set your exit plan before you even enter the trade and have the discipline to follow through. Hesitation is another emotion that traders struggle with. You see a setup, everything looks right, but something holds you back. You hesitate. By the time you decide to enter the trade, you've either missed the best entry point or the setup is no longer valid. Sound familiar? Hesitation often stems from self-doubt or the fear of being wrong. But in trading, hesitation can be just as costly as overtrading. How to beat hesitation. 1. Trust your analysis. If your setup meets the criteria of your trading strategy, don't overthink it. Trust your analysis and take the trade. Use a mechanical system. A mechanical trading system can help eliminate hesitation because it takes the decision making out of your hands. Once your criteria are met, the system executes the trade for you. 3. Practice and review. The more you practice your strategy, the more confident you'll become in your analysis. Confidence reduces hesitation. Start by practicing on demo accounts to refine your skills without risking real money. Keep a trading journal. Documenting your trades can help identify patterns of hesitation. If you notice that you often hesitate on certain setups, you can review these trades and understand why. Self-awareness is the first step toward overcoming hesitation. Greed is one of the most insidious emotions in trading. It often manifests when a trade is going well, and you start thinking, if I just hold on a little longer, I can make even more money. While that may sometimes work, more often than not, greed causes traders to hold on to trades too long, ultimately watching their profits evaporate when the market turns. Greed will cloud your judgment. The market doesn't care about how much you want to make. It moves at its own pace. Your job as a trader is to execute your plan and manage your risk. How to control greed. So, set profit targets. Before you even enter a trade, set a clear profit target. When that target is hit, exit the trade. Don't second guess your plan because of greed. 2. Use trailing stops. A trailing stop moves with the price of the asset and locks in profits if the price begins to reverse. This way, you can ride the momentum while ensuring that your gains are protected if the market turns. 3. Take partial profits. If you're struggling to exit a profitable trade, consider taking partial profits. Close a portion of your position to lock in some gains, while leaving the rest of the position open in case the market continues to move in your favor. Focus on long-term consistency. Don't get caught up in maximizing every trade. Focus on building long-term consistency rather than trying to hit home runs with every trade. A strong mindset is crucial for successful trading. Without mental resilience, even the best strategies will fail. Building a robust mindset takes time and effort, but it's absolutely essential for long-term success in the markets. Key steps to build a strong trading mindset. 1. Embrace losses as part of the game. Losses are inevitable in trading. Even the best traders experience them. The key is to accept that losing is part of the game and to focus on minimizing those losses rather than trying to avoid them entirely. Stay detached from your trades. Don't let a single trade determine your emotional state. Whether you win or lose, stay detached. Each trade is just one small part of your overall journey. Don't let short-term results affect your long-term mindset. 3. Maintain consistency in your routine. Having a consistent trading routine helps build discipline and keeps you focused on your goals. Review your trades daily, practice mindfulness, and stick to your trading plan. Self-care matters. Your mental state outside of trading plays a huge role in your performance inside the market. Take care of your health, get enough sleep, and manage stress outside of trading. A healthy body supports a healthy mind. Learn from your mistakes. Every loss is a learning opportunity. Analyze your losing trades to identify what went wrong. Did emotions cloud your judgment? Did you deviate from your plan? Learn from these mistakes and make adjustments moving forward. At this point, we've talked about various aspects of trading psychology. But how do you practically stop emotions from controlling you when you're in the heat of a trade? Here are some specific techniques to take control of your mind and emotions in trading. 1. Practice mindfulness. Mindfulness techniques like meditation or breathing exercises can help you stay calm during volatile market conditions. Being mindful of your emotional state can prevent you from making impulsive decisions. 2. Use a pre-trade checklist. Before you enter a trade, go through a checklist that confirms all your criteria are met. This helps you stay logical and avoid emotional trading. 3. Take regular breaks. Trading can be mentally exhausting, especially when the market is volatile. Take regular breaks to clear your mind and reset your emotions. Focus on process, not outcome. Instead of fixating on how much money you're making or losing, focus on executing your strategy correctly. Over time, good execution will lead to good results. Visualize success. Before you start your trading day, visualize yourself following your plan and making good decisions. This mental rehearsal can help set a positive tone for the day and reinforce disciplined behavior. Mechanical trading systems offer clear, rule-based strategies that help traders remove emotional decision-making. They can be particularly effective for day traders and scalpers who want a methodical approach to trading, especially on assets like Bitcoin, which is known for its volatility. What is a mechanical trading system? A mechanical trading system is a set of predetermined rules that define when to enter and exit trades. These rules can be based on technical indicators, price patterns, or volume analysis. The key is consistency. You follow the system without letting your emotions influence your decisions. Now, these are the proven trading strategies I promised to give. Let's break it down with step-by-step examples using Bitcoin charts. Moving average crossover strategy, 5-minute chart. The moving average crossover strategy is a simple yet effective mechanical strategy that uses two different moving averages, usually one short-term and one long-term, to signal when to buy or sell. Here's how it works on a 5-minute Bitcoin chart. Short-term moving average, 10-period EMA, exponential moving average. Long-term moving average, 50-period EMA, entry rule. Buy when the 10-period EMA crosses above the 50-period EMA, bullish crossover. Sell or short when the 10-period EMA crosses below the 50-period EMA, bearish crossover. Exit rule. Close the position when the opposite crossover occurs, or set a fixed take profit and stop loss level to protect your capital. Illustration. Let's say you're trading Bitcoin on the 5-minute chart and the 10-period EMA crosses above the 50-period EMA at $28,500. This is your buy signal. A few hours later, Bitcoin climbs to $29,000 and the moving averages cross back down. This is your sell signal. Combining the Relative Strength Index, RSI, with the Moving Average Convergence Divergence, MACD indicator can add more weight to your mechanical system, providing confirmation for entry and exit points. RSI setting, 14-period, used to identify overbought, oversold conditions. MACD setting, 12, 26, 9, used to measure momentum. Entry rule, buy when the RSI is below 30, indicating oversold conditions, and the MACD line crosses above the signal line, bullish signal. Sell when the RSI is above 70, indicating overbought conditions, and the MACD line crosses below the signal line, bearish signal. Exit rule. Exit when either the MACD line crosses in the opposite direction or the RSI returns to neutral, around 50. Illustration. Let's say you're watching the 15-minute Bitcoin chart and the RSI drops below 30, showing Bitcoin is oversold at $27,800. Simultaneously, the MACD gives a bullish signal. You enter the trade, and Bitcoin moves up to $28,500, at which point the RSI reaches 70, signaling it's time to take profit. Stochastic oscillator, 1-hour chart. This system pairs Bollinger Bands with the stochastic oscillator to identify potential reversals. Bollinger Bands are used to determine volatility and price extremes, while the stochastic oscillator measures momentum. Bollinger Band settings, 20-period, 2 standard deviations. Stochastic oscillator settings, 14, 3, 3, entry rule. Buy when the price touches or moves below the lower Bollinger Band and the stochastic oscillator is below 20, oversold zone. Sell when the price touches or moves above the upper Bollinger Band and the stochastic oscillator is above 80, overbought zone. Exit rule. Exit when the price reverts to the middle band or when the stochastic oscillator crosses into neutral territory. Fibonacci retracement with MACD 4-hour chart. The Fibonacci retracement tool is widely used to identify potential reversal levels based on historical price movements. When paired with the MACD, it creates a powerful mechanical trading system that signals entries at key levels. Entry rule. Buy when the price retraces to the 61.8% or 50% Fibonacci level and the MACD gives a bullish signal. MACD line crosses above the signal line. Sell when the price retraces to the 61.8% or 50% Fibonacci level from above and the MACD gives a bearish signal. MACD line crosses below the signal line. Exit rule. Exit at the 23.6% Fibonacci retracement level or when the MACD line crosses back in the opposite direction. Why timeframes matter in mechanical trading? Different timeframes serve different trading goals. 5-minute charts, best for scalping or very short-term trading. Quick entries and exits based on fast signals. 15-minute charts, ideal for intraday trading, offering slightly slower but more reliable signals. 1-hour charts, perfect for swing traders who hold trades for a few hours to a few days. 4-hour charts, suitable for position traders or those looking for longer-term setups. By combining these time frames, you can get a broader perspective. For instance, you might enter a trade on the 5-minute chart based on a quick signal, but confirm it by checking the 1-hour chart to ensure you're in line with the overall trend. Mechanical trading systems, when applied properly, take emotion out of trading and help you stay consistent. Whether you're scalping on a 5-minute chart or holding positions on a 4-hour chart, the key is to follow the rules of your system and avoid overthinking. By using combinations of indicators like moving averages, RSI, MACD, and Bollinger Bands, you can create robust systems that fit your trading style and time horizon. Always remember though, no system is perfect. You will have losing trades. The goal is to remain disciplined and let the system do the work. In the long run, mechanical trading can help you avoid emotional traps and improve your profitability. Let's wrap it up. Trading is not just about having the right strategy, it's about mastering your mind and emotions. The market will always throw you curveballs, but your success will come from how well you manage your emotions. Stick to your plan and remain disciplined, regardless of what happens in the market. Remember, trading is 90% psychological, so focus on building that strong mindset, avoiding overtrading, controlling greed, and learning from every trade. Over time, these small but significant improvements will lead to long-term success. If you found this video helpful, make sure to subscribe and hit the bell icon for more trading tips and strategies. And remember, consistency is key.